What is the best structure for your investments? The structure you choose for your investment property matters more than the property itself. I know that sounds backwards, but stick with me for a second. You could buy the perfect property in the perfect location, but if you structure it wrong, you will hand over tens of thousands in unnecessary tax, lose access to deductions you should be claiming, and potentially unlock yourself into something that cost you money for decades. I am Ash from ClearTax, and over the past 5 years, we have structured property portfolio for our 1,500 investors across Victoria, New South Wales, and South Australia. There are 4 main ways to structure property ownership in Australia. Firstly is individual ownership, which includes joint names. This means buying the property in your personal name, either on your own or with a partner. Next, there is a discretionary trust. This is a separate legal entity that holds the property, with the trustee controlling it and the beneficiaries who can receive the distribution. And then you have the companies, where the property is owned by the company structure, not by you personally. And finally, the self-managed super fund, or SMSF, also give you an option to put the property inside your superannuation fund. Each one treats tax differently and alters your borrowing capacity. They also have very different cost and flexibility attached to them. Think of it like choosing between a hatchback, a 4-wheel drive, an electric car, or a truck. They all get you from A to B, but which one you need depends entirely on where you are going, what you are carrying. So let's break it down one by one. I will start with individual ownership. This is the simplest option. You can buy the property in your name and or with your partner. All rental income gets added to your personal taxable income. So if you are earning 100,000 from your job and the property makes you 15,000 in rental income, you are now taxed on 115,000. If the property is negative geared, meaning it makes a loss after expenses and interest, you can claim that loss against your personal income. When you sell, you pay capital gains tax. But if you have held the property for more than 12 months, you only pay tax on 50% of the gain. This is called CGT discount. So if you bought for 500,000 and sold for 800,000, you made a 300k gain. Only 150 gets added to your income or taxable income that year. Individual ownership works best for high income earners who wants a negative geared and offset losses against their salary. It also works if you are a couple and one person earns a lot less. You can buy in their name and pay less tax at the lower marginal tax rate. But it's not without its downside. First, with a zero asset protection. If you get sued in your business or profession, the property is fair game. Second, if you are a high income earner making 200,000 a year, any rental profit gets taxed at your marginal tax rate, which could be 47%, including the Medicare levy. Third, you cannot split income with anyone else. If it's in your name, it stays in your name for tax purposes. The next structure is a discretionary trust. A discretionary trust is a separate legal entity that you set up with a corporate trustee, who then controls it. Remember, though, the trust owns the property, not you personally. The word discretionary means you can decide each year who receives the income and capital gains from the trust. These people are called beneficiaries, and they are usually your family members. Here is where it can be powerful. Let's say the trust makes $20,000 in rental profit this year. You can distribute that income however you want among the beneficiaries. If your spouse doesn't work or earns very little, you could distribute the full $20,000 to them, then pay tax at their marginal tax rate, which might be 16% or even 0 if they are under the tax-free threshold. Compare that to you paying 47% on the same income. That's a potential tax saving of up to $9,400 in 1 year. Now, let's talk capital gains. The trust still gets a 50% CGT discount, just like individual ownership, but you can distribute the discounted gain to whomsoever as the lowest tax rate that year. So, if you sell and make 300,000 gain, only 150,000 is taxable after the discount. You could split that between yourself, your spouses, and your adult kids to minimize the total tax paid. But there are few things to keep in mind. The first is land tax. In most states, trusts don't get the land tax free threshold that individuals do. In NSW, for example, individual gets 1.075 million of threshold and trust gets 0. So if you own a multiple properties in a trust, you could be paying land tax from $1. Over the decade, that could add up to $20,000 to $50,000 in extra tax. The second is loss quarantine. If the property makes a loss, the loss stays trapped inside the trust. You can't use it to offset your personal income like you can with individual ownership. This is a massive problem for negative geared properties. If you are relying on those tax deductions to help with cash flow, the trust kills the strategy. Finally, inflexibility. Once the property is in the trust, it's expensive and complicated to get it out. All that said, trust works best for investors who owns the positive geared properties, have family members with a lower or zero income to distribute to, and building long-term portfolios, or don't need to claim losses against their personal income. The next structure you can buy the property in is a company. Company is a separate legal entity that owns the property. You might be a director and shareholder, but you don't personally own the asset. Companies pay a flat rate of 25 to 30% tax, depending on whether they are base rate entity. This sounds great if you are a high income earner paying 47% tax. But here is the catch. Companies do not get 50% CGT discount. So if the company sells a property and makes a 300K gain, the full 300K is taxable at 30% tax. That would be $90,000 in tax. Because of this, most people generally avoid using company structure to purchase a property without a clear purpose. But there is a scenario where companies make sense. If you are a business owner with a retained profits sitting in your company, you can lend those funds to your investment company to buy a property. This avoids Division 7A issues, which are the whole mess of tax penalties when you are trying to take money out of the company for personal use. So with that said, companies work best for business owners who have retained earnings, they want to put that in property, who wants to reinvest profits in the long term, or who are comfortable sacrificing the CGT discount for capital efficiency. The last structure I want to talk about is self-managed super fund. So what exactly is it? Think of it like this. Instead of handing your superannuation over to a retail or industry super fund and letting them make all the decisions, you create your own private super fund where you are in the driving seat. You become both the member and the trustee, which means you control how your retirement savings are invested, whether that's a shares, property, or other assets. An SMSF allows you to hold property inside your superannuation fund, and the reason this one is attractive is the rental income inside an SMSF is taxed at just 15%. But on top of that, super fund gets the capital gains tax discount of 1/3 of the gain, but only 2/3 of the capital gains are taxable. This means you are effectively paying 10% on the gross gain of the property. Here is the best bit. If you sell the property after you have started your pension from your SMSF, you possibly pay 0% tax on the gain. On the downside, you can't access the property or the money until you meet the conditions of release, which is usually retirement. You also can't live on the property or let family live in it. Finally, setup costs are high. You will have to pay around $3,000 to $5,000 plus annual compliance cost of $2,000 to $4,000. Now, here is the thing about SMSF. This is super important. What I have just covered is really just scratching the surface. SMSF are incredibly complex structures with strict compliances requirements, investment restrictions, and legal obligations. There are rules around what you can and can't invest in, borrowing restrictions, annual audits, and mountain of paperwork that needs to be done correctly. So before you go down this path, it's absolutely critical that you sit down with a qualified SMSF specialist who can walk you through your specific situation and make sure this strategy actually makes sense for you. Okay, so now that I have gone through the 4 structures, I'm guessing your next question is, how do I figure out which structure is right for me? Ask yourself these 5 questions. Question number 1. What's your current income and what's your partner's income? If there is a big gap, trust becomes more attractive for income splitting. But if you are both on high income earners, individual ownership or a company structure might work better. Question 2. Will this property be positive or negatively geared? If you have a negative geared property, individual ownership is usually best so you can claim the losses. But if your property is positive geared, trust gives you flexibility to distribute the income to low tax beneficiaries. Question number 3. Do you have a business income or only PAYG salary? Business owners with retained profit should lean towards companies or bucket company structures. Plus, PAYG earners usually do best with individual ownership or joint names. Question 4. How long you are planning to hold this property? If you are intending on keeping the property for more than next 5 years or 10 years, the CGT discount comes into play. So go individual or choose a trust structure. Question 5. Do you work in a high-risk profession where you might get sued? If yes, asset protection is the big factor to consider, and trust can offer you some protection. But it only works if you structure it correctly with a corporate trustee. If you don't work in a high-risk profession, you can keep things simple. Here is a bottom line. There is no one-size-fits-all structure. Anyone who tells you always use a trust or never use a company doesn't understand your situation. The right structure depends on your income, your family, your strategy, and your timeline. So if you're about to buy a property and you're not sure which structure to use, book a consultation with us at ClearTax. The link is in the description. Thanks for watching. I'll see you in the next one.